Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my co-host, Nick Kosko. Welcome, Nick.
Hey, it's a pleasure to be back and talk about educating our clients and prospects in an abundant way. We get confronted with a lot of things all the time, questions, and Jim, you know, I always joke with people like, hey, we welcome you to disprove this, right?
Absolutely.
So what we're going to talk about here today is, you know, in the financial world, there's a lot of noise. In the infinite banking world, there's a lot of noise too. YouTube and all kinds of access to the internet has given everybody with some IT skills a platform to pontificate. And shockingly, or not so shockingly, there's a lot of ignorant, I say ignorant and just uneducated, or maybe agenda statements made with an agenda. And I always just ask people, hey, where'd you get that from? And what was their motive for saying that? And we got confronted earlier today with some questions that someone had found on the internet. It's posted anonymously. I suspect it's someone that wants control of your money, who definitely posted a lengthy blog about what they think infinite banking is. So here's what we're going to do today. We're going to go through a few of the bullet points that we were confronted with today, and just educate you. Whether you're new to this or you've been around this for a long time, I believe you'll learn something. So without further ado, Jim, let's get into it.
All right, sounds good, Nick. You know, some of these I have to smile and I would laugh if they weren't so silly. But you know, they start off by saying the insurance banking concept, and we always tell our clients, Nick, that it's the process, not the policy. Nelson pounded that into our heads, right?
Yeah,
because it's the truth. But so the fact that they can't even call it really what it is, it said is not good for anybody to use. Okay, well, that's not true, because I can tell you that it's changed my life, but don't take my word for it. You can take a lot of clients' words for it.
Hey, before you go, hey,
yeah.
If you're new to this, let's just remember the problem we're solving. We're solving one simple problem. That's that we finance everything we buy. We pay interest to other people, or we lose the ability to earn interest when we pay cash. There's no in between, right?
Yep.
And Nelson said, this is about a process, not a product. You can do infinite banking with your checking account, your shoebox money if you want. It's just that through his decades of financial experience, he determined that the most ideal platform for this was this very specifically designed life insurance contract. And then ask yourself, whatever you see in anything, not just what we're saying, just ask yourself one question: compared to what? All right. So when you see the naysayers, someone else with an agenda, just ask that. So, all right. I think we've set the table.
Like you said, you have to figure out why are they saying what they're saying? Where are they coming from? What are they trying to get you to do? So we're trying to get people to think abundantly and grow their wealth. And if you don't want to do that, then you probably should invest in mutual funds and those kinds of things that are Wall Street based, and put all your money in your 401k. If you don't want abundance, all right. Now, if you want scarcity and fear while you're in your older ages of, quote, retirement, which is another word that we don't like and we don't use. Okay. So diving in, Nick, with that.
That's what I was going to say. Let's get at it.
All right. Life insurance loan interest is no longer income tax deductible. The tax law changed and took that big benefit away years ago. All policy loan interest was income tax deductible. Okay, by the way, I'm just reading the comment the way that it is. That comment is really misguided. And the only people that believe that you can't deduct the interest that you pay the insurance company to use their money are people that don't understand how it works. Some of them are life insurance agents. But when you take a loan, your money doesn't go anywhere. You're using the insurance company's money and you're collateralizing your cash value. So you're borrowing the money from a large financial institution, just like a bank. An insurance company could be the seller Okay.
Correct.
And it depends on what you're doing with the money that you borrow. If you could deduct it, if you borrowed it from the bank, then you can deduct it using your policy and the insurance company's money. And the only people that ever get confused about that, again, they don't understand how it works. Now, I'm not going to tell you what's deductible and what's not deductible, but theoretically, if you use that money for a business purpose, and by the way, when you invest in real estate, Nick, is that a business?
Yes.
It's not personal, right?
Nope.
Okay, it's a business. So when you use it for a business purpose, for me and my CPAs, different CPAs, I've always been able to deduct that interest, no problem. And if I had a CPA, by the way, that didn't understand that I wasn't borrowing, taking my own money out, I would educate them. If they still didn't get that, I'd find a new CPA.
Now, we're not giving tax or legal advice here, but we've met with plenty of CPAs over the years to help explain it. There's an IRS interpretation on this, about 170 pages long, that we could send to your CPA if they need some clarification. But it's really just comes down to understanding the structure, where the source of the funds are coming from. It's not your money that you're borrowing at the end of the day.
Absolutely. Okay. Next bullet point. Today, the fixed loan rates on policies are 8%. Not the companies we're using. I do know of a company that is 8%, but I only know of one. So maybe that's what they were researching. And then they say, which we would agree with, there's a big difference between the 5% tax deductible rates. Okay. Yeah. Now he says not long ago. Well, no, those are still available today. We're using them every day. I'm using them. Nick's using them on our personally owned policies. They say, now go ahead, Nick. What?
No, I was just agreeing with you.
Yeah. Okay. Sorry. Some companies are used non-fluctuating, non-guaranteed variable loan rates, but that is even more dangerous since the policyholder cannot control with certainty the ultimate outcome. Nick,
I mean, so let's understand what's going on.
The variable rate. You want to explain the variable rate?
Yeah, the variable rate. Let's see. So, the one company that we use, they index their variable rate to the corporate Moody's corporate bond rate. Yep. It can adjust one time a quarter. All right. I've had my oldest policies 6 or 7 years old. It's never changed. It's still been at about that same rate. We've got policies with another company that's quote unquote variable. They're at 4.4%, somewhere around there. Okay. So it is. And one thing that I think about too is we've got the direct recognition versus non-direct recognition. So when we have direct recognition, that means when we take a loan from it, our dividend is lower to reflect the amount of money that we have borrowed. Okay. Well, when we have direct recognition, we get a fixed interest rate. Okay. That's what we're getting. We have non-direct recognition. All right. So which is what we're doing, which is what we're teaching our clients to do, is to take that money, put it in motion, right, by cash flow assets and get more money flowing back to us. Well, when we do non-direct recognition, our dividend rate is not lowered accordingly. So guess what? We have a variable interest rate. Well, with some companies right now, the variable and the fixed is the same rate. So why wouldn't I want to participate in all the dividend? And I always think about it too, like, hey, if interest rates went to say 10%, well, I may still stay in the variable interest rate. I may choose to, because guess what? That means the insurance company's putting our premium dollars to work and earning more interest. So I want to participate in more profitability of the company. Now, let's say it got really crazy and it went to 50% or something. Maybe some crazy market force that I can't foresee. Well, guess what? I can choose to just stay at the fixed interest rate of 5%. It's really a win-win for me. But it's just understanding that this statement here in this thing is not a one size fits all. It's, there's still variable interest rates out there that very much works for me.
So remember what how this kind of infinite banking concept was born and Nelson's on his knees at 3 o'clock in the morning praying because he's in such a bad situation, owing more than on $500,000, 20% tax. And he says, I can borrow from my policies at 8%. Now, this is back in the 80s, right? When interest rates are super high, obviously, because that's why he's paying 20 some percent.
Sure.
And he says, I can borrow from my policies at 8. Okay, so this, Nelson was celebrating that. This guy somehow like figuring out somehow 8% today. I mean, I don't know any company. I do know one company charging 8%, but to your point, he was paying 20 something. He paid 8, and that's what allowed him to get out of the predicament that he was in. So when we think of these interest rates, by the way, right now, all the 7702 rules definition, the MEC rules are changing, right? And that also means that every insurance company is going to, or they can lower their guarantee, depends on where their guarantee is at now. And they can lower their guarantee. They can also lower their interest rate, because if they lower the guarantee, then they can lower the interest rate. And the companies that we've talked to and the actuaries that we've talked to with those companies, they are going to lower that interest rate.
Yeah.
Okay? So what does that mean? That means, yeah, things change, but the policy is the money pool in our behavior and how we're using it. And we might have policies that are charging 5%. We might have policies that are charging 4%. We might have policies that are charging 6%. Still going to work. Okay. Yeah. So that is just not a good bullet part or an argument. Yeah. Now, the next one is a little outdated.
Yeah.
They say, unlike in the past, the IRS passed MEC rules on life insurance policies to prevent consumers from overfunding their policies with high cash values and low death benefits. If the MEC standards, that's not really the right way to say it, are not met, the policy becomes income taxable for all withdrawals. Okay. Now, there's so many things wrong with that statement, but we're not withdrawing the money, Nick. We're borrowing the insurance company's money and using our money as our cash value as collateral. Okay, so let's just get rid of that last comment. Sorry, that just doesn't make any sense. The MEC line was created in 1986, took effect in 1988. Okay, I've been doing this almost 34 years, and I've always lived with the MEC. So I didn't change. And yes, from 1980, when universal life was invented by E.F. Hutton, and you have all this flexibility, you could write a check for $100,000, Nick, have $100,000 of cash value and a little bit more than $100,000 of death benefit, right?
Amazing. Absolutely amazing, right? Amazing.
And who was selling most of this life insurance?
Financial advisors.
That's right. Stockbrokers and financial advisors,
Street,
right? And so they got on the radar of the IRS and the Congress, and that rule was changed. Okay. Now,
they were people that had it when the rule changed were grandfathered in, though.
That's right. That means they still have those policies. So these other, it's funny that he's going back. Hey, back 100 years ago when the Federal Reserve was created, okay, got it, buddy. But I mean, come on, we've been dealing with those rules, and those rules are changing this year, Nick.
Yeah.
For the betterment of the consumer, as far as the amount of money you can put into the insurance company.
That's right.
Right. And we have 3 companies that we're working with and helping them on the design and giving our opinion. And we're on committees showing or helping these companies and making sure, protecting our clients for their future purchases, because every single person that does infinite banking, once they get it and they get money flowing back to them, they're going to expand their systems. So that means you got to have more policy. You got to have more money pools, right? Every single one of them is going to benefit from the work that these insurance companies are doing, because they like this business. Okay.
Yeah.
Anything to add to that?
No, it would be that dead horse. Pretty good.
Okay. The next bullet point, the mortality age tables. Okay. The mortality tables. Okay. and have been revised upward to ages 100 and 120.
Sneaky insurance companies, man.
These
That
sneaky
is
insurance companies. They're doing it, Nick. They're doing it to try to take something away from the consumer. Is that why they did that?
no.
Well, why did they change? It used to be like life paid up at 90 or 95, and then it endowed, meaning when it endows, your cash value is the same as your death benefit, right?
Yeah.
At 100. So why would they switch it to 121?
Well, a couple of reasons. I'll let you fill in some of them. One of them is, you could have a pretty significant taxable event if you were to attain that age and get that check.
Right. Well, do people live past 100?
Yeah, they do.
I'm in Florida. There's a lot of people over 100 here.
I got two great grandmothers that lived over 100.
Wow, you got good genes, Nick.
Yeah, that's why I'm preferred plus.
That's why you're preferred plus. That's right. Okay. We're not going to go down that rabbit hole, but
he says
it's simply this is the insurance company wants to protect you and make sure that when you die, the policy has not endowed. It's still in force, right? It doesn't end before your death. It's for your whole life. That's why it's called whole life, right? And so they, at the 1984 mortality tables were to 100 because in 1984 they calculated that people weren't living past 100, right? Then some people started to. So the next mortality tables came out to 121.
Yeah.
But it's been that way for almost 20 years, since 2001.
Yeah, we just had new mortality tables and they kept at 121.
Every 16 years, whether we like it or not, it seems like. Again, I've been only doing this 33 years, so I've only seen that change from 84, 2001, 2017. Okay. Now, what's 16 years on top of 17? Is that 33? It's not that far away. I'm sure I'll be doing this by then. Anyway, I just wanted to see if I was going to have one more mortality tip, maybe two more. Who knows? I'm only halfway through this before I graduate from this world. So, all right. So that just now, was it better? Could you put more money in a policy when it endowed at 100, or was it? Sure. Absolutely. The shorter the mortality tables, the more money we could put in. So is he right? It had a dramatic effect, and it still fits, still works. I mean, dividends used to pay 9%. Did that have a dramatic effect on cash values? Absolutely. But So what? We're using it as a bank. It's not just sitting there. And Nick, can I make up the difference in dividend by going out and buying a cash flowing asset?
Yeah. But
can I blow that out of the water? It is the rate of return inside the insurance contract, the thing that I should be focusing on.
No, what we should focus on is taking that volume of interest that's going away from us and redirecting it back to us. That trumps everything, frankly.
There's a concept. I wonder who. All right, Nelson pounded that, right? Nelson would say, "This is so simple. Don't complicate it." This guy is really I say guy because most women are not this stupid to be able to write these comments. So, all
right, we got one more here.
All right,
I'll read it for you.
Okay,
so you can take a breather for a second.
Okay.
And then because I know in your career over 34 years you've dealt with this a little bit. Yeah. So estate planning and taxation have changed, making life insurance banking concepts less effective and efficient.
Yeah. Did we buy? Okay. So when you do estate planning, you use trusts, and the primary trust that you would use is an irrevocable life insurance trust, because that isn't part of your estate, right? So we're trying to keep dollars, assets out of your estate. So we want the death benefit to be out of your estate so that we can pay estate taxes. And the concept is all of the funding inside that insurance contract is going to be dramatically less than, to use his word, than the tax that you would have to pay at the time of your death or at the time of your spouse's death, because currently you could pass 100% of your estate to your spouse tax-free, regardless of how big the estate is. it's the second death, which again, back to the women thing, is normally going to be your spouse, your wife, right?
Yeah.
So this has changed. And I mean, forever, Nick, the first 20 years or so of my career, there was no changes to the state tax law. And then, I mean, there are no major changes, I should say. And now it just matters who's in charge, right, of which way they're trying to push it. Right now, you can get about $13 million passed to the next generation without paying a state tax. Okay. And people sometimes say to me, well, if you own these policies individually and you're going to, and all of this is going to be in your estate. Yeah. These millions and millions of dollars that you're going to have because of your doing infinite banking and taking over the banking function in your life. And like Nelson said, bringing it to the you and me level, all of those millions of dollars that generated, you could pay a state tax on. Because here's the bottom line, Nick. I'm 56, planning on being here another 56 or so. Maybe I'll make it to 121, but I have no idea what a state tax are going to be when I die.
Would you rather pay 5,000 in taxes or 5 million in taxes?
Nick, I think that's a great place to wrap it up, because I'd rather pay $50 million in tax, because that means I got a lot of money.
Yeah. So here's the thing. If you got more questions, you want to dive into this more, go to CreateTailwind.com, click on contact us. There's some resources on there too that are free. Go to our YouTube channel. It's CreateTailwind, all one word, lots of videos on there. If you listen to this podcast, we'd ask that you rate it. There's you can rate between 1 and 5 stars. 5 stars is the only appropriate amount of stars for as good looking as we are here on our YouTube channel, and for the content that we bring. But we'll tackle more of these things in due time. If there's questions that you have that we're not addressing, by all means, hit the contact button on our website and fire off that question. We'd be happy to address that here on this forum. If you don't want to have an individual meeting. So anything else, Jim?
Well, I would say, if you hear some noise out there and you want us to address it, reach out to us, because I love, our meeting, just to kind of wrap everything up, our meeting this morning ended the way most of those meetings end, is after we answered about half of the questions, or maybe a little bit more, they said, hey, can we move on to the good stuff? Because obviously I got this information, it's false. And like, you're explaining why this is false has me excited about moving forward and doing infinite banking. So can we get back to that? And obviously it wasn't we will answer for our clients, for anybody that wants to work with us. We answer every question. Now, that guy, unfortunately, is, I think, in the herd, Nick. And there's nothing good that happens in the herd. So until next time, I'm your host, Jim Oliver. Thank you, Nick, for joining me today. And thank you, audience, for joining us. And thank you for being a participant in this podcast. And we love bringing you the content every week. Again, break away or you're in trouble. Take care.